business. It's not an individual. So, and without further ado, I'm going to introduce Jeremy Radcliffe to you guys. He is an awesome lender. I've known him for a very, very, very long time, and we are going to walk together through just the basics of financing, the things you need to know. Of course, these classes are better when you guys have questions and are interactive. So I don't think Jeremy or I would be upset if you're not shy. Raise your hand, put it into the chat, and we'll go from there. Jeremy, anything to add? You want to introduce yourself a little bit?
Sure. First of all, Zareen, thanks so much. I appreciate the opportunity to jump in. And
thanks for doing this.
I think you mentioned I feel like we've known each other for 12 plus years.
A long time.
Yeah, it's been great. I remember we had coffee a long time ago down over off of Central Expressway in your old office. So
when we were babies.
I know, right? Well, thank you. First of all, let me say thanks. I recognize some of your names, and I appreciate the opportunity to sit with you guys today. I would agree with Zareen. My goal is to make a topic that may not be the most exciting part of your day, but hopefully it'll be educational and be helpful in terms of you guys getting some deals or maybe looking at some information in a different way. Yeah, I've been in the Dallas market for almost 12 years, a 10-year plus D Magazine Best Mortgage Loan Originator, top 1% in the nation. I think the thing that I'm most proud of is that we've just got a great reputation in our market, and most of that's coming from taking good care of agents like yourselves. We understand the importance of a good partnership between a realtor and a lender, and our goal is to make that transition as smooth as possible. And in fact, my goal is that should someone be referred to me, that person would go back to the referring agent and say, thank you for that introduction. That was a really great connection for us. So without further ado, Zareen, are you good with me getting started on this?
Yeah, let's go.
Okay,
let's go.
Perfect. All right.
Thank you.
So basically what we want to talk through today was some of the best practices in terms of working with lenders, give you some ideas in terms of how mortgages really work, an overview of the different types of loans, and then some of the different, Zareen's going to take that last part of the section in terms of contract addendums and how to write some of those third-party financing addendums. I think in terms of working with lenders, the best advice I can give to an agent, seasoned or new, would be you've really got to find someone that you feel like is, I think it's a combination of, hey, I feel like this person knows what they're talking about. I feel like they communicate well and that we can communicate well with each other. And then also there's an expectation of transparency. I've seen situations where that's not always the case, and you would want to make sure that you're working with someone that's going to be upfront, even if that might be bad news. I remember early on, when I got started, I felt at moments feeling like, man, I got over my skis on certain situations. I was like, I'm never going to do that again, just because I didn't sleep for a weekend. It wound up working out okay, but you've got to, as a lender, I started recognizing, man, if Zareen's going to send me a client, I've got to make sure that before they go under contract or before they go spend 2 or 3 weekends looking at properties in the car for 15 hours or however long that takes you guys, we've got to make sure that these are actually qualified, vetted clients. So sometimes that requires a little bit more, different types of buyers require more nuances in terms of whether they're self-employed or not. But if you've got a lender that you can work with that you feel like has a good understanding of what the guidelines are, and they can also be responsive in terms of communicating really well, I think that's a good fit. So that's something we want to do. And I'd love to connect with you after this class at any point. So you've got my contact information if you ever have any questions on that. In terms of, let me see here, in terms of kind of what really is the nature of what we're doing on the mortgage side, there's a couple of different nuances to this. And let me just kind of walk you through one of the big things that you've probably heard about is this idea of pre-qualification versus pre-approved. If you have worked with or have heard of some of the big box lenders, and I won't use any names today, but a lot of times they will have issued a pre-qualification. Pre-qualification is essentially a client who's had their credit pulled, and this can all happen online. They've had their credit pulled, they've inputted how much income they make, they've typed in how much assets they have, and then it will just basically spit out, it's a formula that says, yeah, you're pre-qualified for this amount. The problem is if you ever talk to someone who is self-employed or is commission-based, the way their income comes across on what they have in their mind versus how they actually file their tax returns, or how their income is split out year over year. There's nuances to it. So it can be a little bit more complicated than that. And the way underwriting looks at that is a really key piece. So what I would describe the difference between pre-qualification and pre-approved is where we've actually reviewed, as a loan team, reviewed those actual documents that are built out on that application. So I've looked at pay stubs, I've looked at W-2s, I've looked at tax returns, and verified that information to make sure that this is how an underwriter is going to view it. And then using that, they are now they've crossed over into that range of pre-approved. A lot of times that includes as well having what we call automated underwriting system approval. You've probably heard of AUS, or you will soon. Fannie and Freddie are kind of the big parents in terms of the mortgage world. They set the AUS guidelines. It's essentially a computer program. It's an algorithm that looks at everyone's credit, assets, income, which we'll talk about in a little bit. It takes all of that information and evaluates and says, hey, as long as we've got credit scores at this rate, we've got debt to income ratios at this rate, this person's approved. It's a pass fail. Okay.
That's it, guys. That's an important distinction right now when it's so competitive for buyers. A buyer that's just pre-qualified is not as attractive as a buyer that's pre-approved. That make sense? Okay.
Correct. Yes. Thank you. And in fact, it does make a big difference. We're even starting to take that to a new level. And I sent an email out over the weekend where we're starting to see benefits of having clients actually credit approved, which what that means is if I'm taking a client through the actual underwriting process with a TBD address. So now it's allowing agents to write offers that are, you could eliminate or completely reduce the amount of time on the third-party financing. So it does make for stronger offers. So there's several ways you could approach that. So and always want to make sure that you've included that pre-qualification letter or pre-approval letter in your offer. I've heard different opinions whether that dollar amount on the offer has to match exactly what you're offering. My experience has been that most agents who are listing properties realize that someone's not going to buy at their very highest approved amount, but it's usually easy for a client to have that letter updated to match your offer. So however you want to communicate with your lender in that sense. And then again, as I mentioned early on, just having that quick and ease of communication between yourself and the lender. Hey, is this person going to be available to me on the weekends? Can we get an updated letter if we need it? Can we look at a new property if we need it? I had an agent on Sunday. She's like, hey, I hate to do this to you, but I've got an in-town buyer. He's not represented by a lender. All offers are due by 3 o'clock. Is this something you can do? It just happened to be that the agent or the client was very motivated. So we were able to get him the pre-approval by that afternoon to get him going. So very important to be able to communicate along those ways. Yeah, and another thing too on this is it's nice as a lender when I can call a listing agent and just say, hey, Richard, I'm working with Zareen. Want to let you know she's recently sent an offer over to you. We've done a full pre-approval on this client. My name's Jeremy. We're a local lender. If you have any questions on this offer, when I go through it, happy to help. Here's my cell phone number. So having that availability to your lender, it kind of acts as an extension of you as the buyer's agent. So does that make sense? Perfect. So in terms of kind of what we're looking at on the mortgage side, you guys have probably seen this in your classes. It breaks down into 4 main pieces. Essentially what we're looking for, what Fannie and Freddie or any jumbo underwriters looking at, is they're trying to get an idea of what really is the income of this client. What's the debt situation? So debt being everything from student loans to car payments to credit cards. How does their credit score look? Credit does come into account on a big space. And I think the biggest difference between people overspending on a house or not is if they've taken good care of their credit. So the best thing you could do, and what I'd recommend all agents do, is even if your client is 6 months out from looking to purchase, time is the biggest issue on credit. So I tell clients who reach out and say, hey, we're not looking to buy anything for 6 months. And I'm like, you know what, that's great. I would recommend if you have any questions about what your scores might be, let's go ahead and take a look at it now. If your scores are good any credit inquiry is not going to affect you too much. If your score is not exactly where you think it should be, we've got time to fix that. And we also have the means to make adjustments on some of that. Lenders have access to what's called rapid rescores. We can work with clients to get things updated with the credit bureaus in short timeframes. But when you're 30 days out from trying to get approved, purchase a house, execute a contract, that time frame gets shortened, so you don't have as much of a runway. So that's why I say it's super important to try to get that done as early as possible when you're talking with your clients. Assets is the next big thing in terms of where the assets coming from. Different guidelines allow for gift funds. Different guidelines allow for you to use income or assets in different ways. Assets, I think, should also be considered in this case the collateral on the purchase, which would be the property you're looking to buy. So that could include the appraisal, what type of property is. We'll talk about condos in a little bit, what drives some of the differences on that. So all of those pieces together really looks at what we're trying to figure out is someone qualified. And I mentioned earlier, a lot of times it's just a pass fail. It's not the automated underwriting systems will say yes, approved, or it will say, you know what, we need more assets, or credit needs to be increased to a certain degree. Having access to someone who knows how those AUS findings work or knows how to tweak some of that information makes a big difference in getting clients approved or not approved. So if you have any questions on that aspect, you guys have access to this slide as well after our class, and then we're happy to clarify on any of that. The next piece you probably heard of, and I had never heard of it in terms of treated like a seesaw, but I like the illustration. Anyone familiar with the idea of discount points? So you've heard of someone saying, hey, if I paid a little bit, I could get a lower rate. Someone mentioned par rate, someone mentioned lender credit. So this slide is intended to illustrate some of the differences on that. The idea being par rate would be, what is the market providing right now? Now, to be fair, every lender it's like if you were to buy a car, every car dealership is going to have their own margins, okay? For the most part, margins are going to be pretty consistent across the board. That's why most lenders are within 1/8 to 1/4% in terms of interest rates. But that house price, so as a loan officer, I'm not compensated based on interest rate. Back in 2008, 2009, when the financial crisis hit, they changed the guidelines. They said, hey, loan officers can no longer be compensated by pushing their clients to a higher rate. So what they said was, we now have what's called par pricing. Par pricing basically says this is what the interest rate is based on this credit score, based on this loan to value, which is how much, the inverse of how much money you're putting down. Taking all of that into account, this is what the rate would be. I'm going to give you a couple of examples, but in this one it shows, so let's say the par rate, and this is not rates today, so this is going to break down at some point. Let's say today's pricing on 20% down, excuse me, 20% down, let's say that was 4%. Someone had excellent credit, let's say it was 4%. You would have the option to get lender credit, say, you know what, I don't think I'm going to be in this property for very long. It's a short term. We're here for 3 or 4 years based on a work assignment. We don't need the longer term, lower fixed payments. We prefer our cash a little bit more. So let's say I take a higher rate at 4.25%. And I'm going to show you an example here in a moment of taking a lender credit, which would reduce how much money they have to bring to closing. Okay, so that's kind of the nuance number one. The discount point option would show you if you're deciding to pay points, so your rate is lower, but the cost to get that rate are higher. So now instead of getting 4% the par rate, you're paying extra money at closing to get a 3.75% rate, which, hey, this is a long-term home for me and my family. We're going to be here for 10 years. We want the lowest rate we possibly can get. That makes sense. And the math around that will show you, hey, you're going to break even at this certain amount. And I'll show you how that works here in a moment. So you're going to hear about this a lot. Every lender, I think for the most part, we try to start from a par pricing. And then once I have a contract, I'll say, hey, there's several different ways we can structure this. Let's talk through your goals, short and long term. Figure out what you're trying to do. Is this a long-term home for you? Is this a shorter term hold? How are you feeling about your cash position? Are you comfortable with payments, etc.? So here's this example, and I know these numbers, some of you see this and you're immediately thinking, oh my gosh, I did not sign up for a financial class this morning. But if you watch this, I think it's gonna be very helpful in clearing up some of the confusion on the par versus lender credit versus discount.
This is good, Jeremy. I think this is helpful to see. We definitely hear those words. So to really understand it is good. So thank you.
Absolutely. So as you look down, there's three basically columns. You're going to see the scenario of the par pricing right here. You'll see the scenario of the lender credit and the discount. What I did was I did a purchase price across the board of 500,000. Let's say someone's going to put down 20%. So they have a loan amount of 400,000. Okay, you can see that. I mentioned in the par rate, you've got 4%. APR you can ignore. We're just, for whatever reason, lenders are always required to show the APR. Let's say 4% is the APR on the par pricing, 4.25 or 3.75 are the three different rates that we're talking about.
And APR is just the actual cost, the interest rate with the cost built in?
That's correct. Yes, it stands for annual percentage rate. Every rate, there's always going to be a little bit of a delta between the rate and APR because there are costs associated with the loan. And so the idea is that you could take two lenders with the same rates. If one lender's rate, if they have the exact same rates, but one APR is higher, then it means that it's costing more money to get that rate.
And so those are just closing costs. Those aren't like annual costs of service.
No, right. The payment is based on the actual interest rate, not the APR.
Perfect. Does that make sense, guys? Okay, good.
A lot of nodding heads. I love it. So you'll see here how the payment changes. So as you go, obviously the 4% is going to be in the middle of the road. Compared to the lender credit, which is going to have the highest monthly payment at $1,967. And I'm just showing you principal and interest on this scenario. So you're going to have the highest payment here, but your cash to close is going to be $100,000. It's just your down payment. And what I was using is saying at 400,000 lender credit, you could get 1% in lender credit, which would be $4,000. On the discount, it's costing you one discount point, which is also equal to 1% of the loan amount. So it's costing you $4,000 to get that rate. So you've got a swing of $100,000 to $108,000 at closing for the benefit of your payment going down by $115 a month. So the question is, if I were a buyer, would I rather have a monthly savings of $115 a month? Or would I rather bring $8,000 less to closing? This is why I say it's super important to not just to counsel your clients and say, make sure that you're talking with someone who knows how to structure and fit what you're trying to do in terms of long-term goals. Because if I knew someone was looking to buy a house and this is a starter home and they don't think they're going to be for very long, I would say, hey, you know what, you could bring $8,000 less to closing. You're not going to make up that difference in a lower monthly payment. The lower rate does not make sense in your scenario because it's going to take some time to get to break even on that $115 a month savings, but you're bringing $8,000 more to closing. And then what I was showing right here is over 60 months, you can see how that savings rolls out. Okay. There's so many different ways you can look at this. I just try to simplify it, but that's the basic premise between par rates, discount rates, and lender credits. Okay. Any questions on that? Please feel free to raise your hand if you have a question on it. And Zarina, I don't know if I can see any hands raised if that were the case.
No, I'll let you know if anyone has questions. Y'all can also just unmute. I think that's a good walkthrough of understanding the basic vocabularies of like the nuances of the different ways to structure a loan. Yeah, and this screen showing that comparison was exactly that monthly payment difference between the different rates and then what that savings is. And this is actually a screenshot of a software that we use when we're talking with clients. The previous screenshot I'd sent, I don't think it worked from a formatting standpoint. So this is what I go through with my clients when they're under contract or on kind of a preliminary scenario call. Hey, here's different ways we could look at this. Let's talk through what your goals are. This next idea is, you guys have probably heard, and I've had so many people come to me in the last few years saying, well, I don't have 20% down to, I don't have enough money for down payment. Just in case you guys didn't know, you don't have to put down 20%. When I say that, I'm probably going to just put a little caveat in there. When I'm talking about conforming or conventional financing, it does not require 20% down. It doesn't necessarily require that on jumbo loans, but it does change, the guidelines change a little bit. So the idea, and you guys are probably familiar with private mortgage insurance, anytime your down payment
is less than 20%, or your loan to value, which is how we really look at it. It's the inverse of down payment. If your loan to value is greater than 80%, Fannie and Freddie require that the borrower have private mortgage insurance. That insurance is not to their benefit. It's actually to the lender's benefit to prevent, should the client default on their mortgage at any point, that private mortgage insurance kicks in to protect the lender. Okay. Mortgage insurance is priced based on credit scores and loan to value. So as you go down in loan to value, so let's say 95%, 90%, 85%, it gets cheaper as you go down all the way down to 80%, which is when that PMI drops off. Credit scores come into play a lot in terms of what those rates are. So that's why it's super important that your clients keep an eye on what their scores are on the credit end. This screen showing that 7% median down payment for first-time buyers. So the idea being that putting down less than 20%, what I would say is that a majority of my clients are not getting to 20% down. And when I sit down and talk with them and I'm showing them, hey, here's a scenario where you didn't use all your cash. Let's say we did 10% down. You could use that 10% for paying down other debt, and there's reasons why that might be beneficial to them. That being said, the thing that I think sticks out the most about not putting down the 20%, I'm not saying it's a bad thing, but what I've seen it be is a deterrent for people trying to get into the market now. So if you consider someone's looking to put down 20%, you have to imagine that might take them longer to save. It could take them 2 or 3 more years, as much time to save that amount of money. What's happening during that time is I feel like they're missing out on a gain of wealth, because if you consider what property values have done in the DFW area over the last few years, Serene, I don't know, I've heard anywhere from 10 to 20% value increases year over year. They're missing out on the opportunity to own that home and then now get to own that appreciation because they've been waiting for that additional money. It also allows you to boost your purchasing power. You can get in. If your debt to income ratios are where they need to be, you could borrow more money, which allows you to increase your purchase price, which can be the difference of getting a house that you want, or maybe a house that they had to settle for. Whoop, I went the wrong way. So this screen right here shows a quick scenario of someone looking to do 20% down versus someone doing 10% down. And I know this is a lot of information, so I'll walk you through it real quick. Same scenario we talked about here a moment ago, someone that's looking at 500,000, a loan amount of 400, doing 4%, versus someone doing 10% down, which would be a loan amount of 450, same rate really doesn't adjust very much. You can see the cash to close here is 104,000 versus 54,000. Okay, that's including estimating 4,000 in closing costs. You can see the payment of 1909 is obviously going to be lower than the 2148. I just made assumptions that property taxes and insurance would be included in the payment, let's say 800 and 200. You can see that the mortgage insurance is $63 a month. So I asked you the question, to be fair, the actual payment difference is $302 a month because they're borrowing more principal, right? But the cost of the actual mortgage insurance is $63 a month. So you're saying for a client who says, hey, I've got to get to 20%, I say, you know what, you could actually capture that appreciation starting now, as opposed to waiting 2 or 3 more years to get to your down payment. And it's going to cost you $63 in mortgage insurance. And obviously, because you're borrowing more money, the principal difference is there, but you're bringing 50,000 less to closing. Time value money in my mind says, man, I'd rather capture that value because I'm going to see that benefit increase over the long line. And then they actually have the ability to pay down principal if they wanted to get rid of that mortgage insurance. I think people who are financially savvy are starting to recognize this, and they're not, in a lot of cases, they're not shooting for the full 20%. So does that make sense? Any questions on the PMI?
I did this when I bought my Fort Worth house because I knew I was going to do a remodel and I wanted to save my cash. So I
Yep.
had I didn't put 20% down because I wanted to save the cash for the remodel. But as soon as I remodeled it, I had it appraised and obviously the value had gone up. So then I
Yep.
didn't have to pay the mortgage insurance anymore. That makes sense.
Yep. There's certain nuances to that allow you to drop the PMI. You want to make sure you talk to the lender who's servicing the loan, because there are certain guidelines that any seller servicer is required to follow. But in the cases Zareen mentioned, because she did do improvements, she could go back and say, hey, I added in this additional value. Can we get it appraised? What doesn't allow, and what I think is being miscommunicated to clients a lot, is you can't just say, hey, property values have gone up so much over the last 2 years. Can I get it reappraised? It doesn't work like that. They can't just take appreciation without any improvements added to make up the difference. Does that make sense?
Y'all have questions? Anybody? Is this making sense? Thumbs up. Good. Okay.
Perfect. All right. Well, I'm going to run through this next part. These are kind of talking through the, I feel like that was the part that was so important to communicate, because I see a lot of misinformation. Here's different loan types. You guys have seen this for sure. We've been talking mostly about conventional financing, often referred to as conforming or conventional or standard financing. Allows you to get in as low as 3% down, which is actually a newer program. You know, FHA used to be the only one you could do 3.5%. 3% down, 5% down. This is probably the program I put 95% of my clients in, because it usually works out to the best of their benefit in the long run. Minimum of 620 FICO scores. I'll tell you this on the credit scores on these screens. You've got to hold these lightly because they are moving targets. Sometimes different investors or different lenders will adjust what they're comfortable on the credit score. So you want to make sure you communicate with your lender. Say, hey, can you good? Anytime you get below 620, you're going to run into some additional nuances on your credits. And I don't know how often you guys are working with clients in that scoring model. What we would probably recommend they do is they're going to save money and be in a better financial situation if we can help them get their credit boosted. Seller can actually pay closing costs. There's certain nuances to how much that is. It's based on the loan to value. So be sure to communicate with your lender. The thing on the selling costs is you have to be careful. The buyer can only receive credit for actual closing costs. So they can't, early on, I mentioned to you, I got in over my skis early on in my career. I had an agent who had promised their client, I think it was like $15,000 in seller concessions. There was only about $8,000 in closing costs, and they communicated that the client would get the difference at closing. It didn't work out like that. So make sure that you are communicating with your lender. Otherwise, you're going to leave a lot of money on the table if you go too high on that. Jumbo loans. So you guys have probably heard in the last couple, I think it was end of 2021, Fannie and Freddie came out. They changed the conforming loan amount to $647,201. It jumped up almost $100,000. Just for context, since I think in 2017, I think the loan amount was $417. This just speaks to how much we're seeing appreciation happen in the market. And what they're doing is they're taking an average sales price, or kind of an average, they took a national average of what's going on with property values around the country, and they look at this on an annual basis. 647 is a massive amount of money for people to be able to purchase with only 5% down. So be sure and encourage your clients who were maybe previously thinking they were not available to purchase because it was jumbo guidelines. You can now get in as low as 647,200. That's why I mentioned the jumbo loans is 647,201. I was looking at it, Zareen, in your original slide. I think we had a max of 2 million. We're now seeing loan amounts go as high as 4 million. You actually have to talk to your lender and figure out what their max jumbo loan is. My experience has been when someone starts getting north of 2 or 3 million, they're probably going to start working with a private wealth advisor or using their assets in some unique way on that. It's still considered conventional, but it's heavier underwriting guidelines. So just be sure if you've got a client who's looking at that higher price point, you hands down, you want to make sure that they're getting pre-approved, because it's just tougher. I mean, this is private money. These are done by large investors, and it's a lot tighter underwriting. So generally what we're looking at, let's say a quick, easy example is, if Fannie and Freddie allows me to use 1-year tax returns for a self-employed borrower, the jumbo, for the most part, is going to require 2-year average. Well, if you talk to anyone who had a business in the last 2 years, it could have been very different for them in 2020 versus 2019 due to the pandemic. So that's something that's really important, is looking at what are the jumbo guidelines, and then having your loan officer jump in and help you out. FHA, this is the Federal Housing Administration. It used to be sometimes referred to as a first-time homebuyer program. A lot of people would put clients in an FHA loan. It's a great program. It's not my favorite program for someone who can qualify with conventional, because there are some upfront costs. You probably heard of the upfront mortgage insurance. It's almost 2% of the loan amount. A lot of times you've heard that FHA mortgage insurance does not go away depending on the program and the loan to value. That's true. What it does do is it allows, the benefit of FHA is allows someone to go higher on their debt to income ratio. So it allows a higher ratio in terms of their debts over their income, which might be the difference of someone qualifying or not qualifying. It also allows for non-traditional credit, someone who maybe has doesn't have a lot of credit history, but they could show other means of credit. So it's a great program. Again, the importance of communicating with a lender and figuring out, is this the best program for their clients? Makes sense.
So in this market, as you guys know, as listing agents, when you get an offer from cash and you get an offer from a conventional buyer and you get an offer from an FHA buyer, the FHA buyer is usually the least attractive just because it means they're, likely not as financially qualified, which can just always cause a hiccup. And also when an FHA appraisal is done, they come out and they not only just appraise the house for value like they do in conventional, they oftentimes have like physical requirements that the house has to meet and repairs are required. So it's just another hurdle. It's not, it doesn't, if you have an FHA buyer, that's okay, but just know that it's more of a challenge. It's viewed less favorably by seller. Does that make sense? Jeremy, do you want to expand on that at all?
Yeah, and I think that might be why it's probably not my favorite, because I know I think so much in terms of what listing agents or buyers agents are working with. And I just rarely see, if I have a buyer who is a 3% conventional versus 3.5% FHA, just because I think there's a bit of a stigma to the FHA. It's not a bad program. It's just like you said, Zareen, there's kind of agents are taught, maybe that's not as strong, or it can create some issues down the line. I would recommend seeing if there's a way to get them to go conventional, if at all possible. Yep.
And if you can, and you have a buyer that's FHA and they're like your precious sweet first time home buyers or whatever their story is, and they can only do it through FHA, then like figure out what is the great story that you're going to tell the listing agent to make these buyers attractive, right? Like just figure out
that's a great idea.
To communicate why they're, good buyers for the house and they're going to show up.
I love that. Perfect. VA, kind of another jumbo, or it's another government program. I didn't mean to say jumbo. VA is sponsored by the Veterans Administration. So it's good for veterans, active duty, reservists, National Guard members. You can actually get up to 100% financing up to $2 million. There is what's called the guarantee fee, or essentially it's a fee on top of the loan amount that's required, that gets actually raised on top of the loan amount, unless the vet is what's called disabled, or they have some exemptions on top of that funding fee. That's a great program for our vets. I'm a big fan of it. It also can have a nuance if you're a listing agent and you have a conventional buyer versus a VA, because there are some requirements on the VA side that the seller is required to pay for. I'll try to put something together and send that over to Zareen. There's some nuances and miscommunication on what that actually is, but it does allow someone, a vet, to get in at a lower credit score. It allows for higher debt to income ratios, and there's some flexibility in some of the underwriting. Great program for our vets.
Brian, you had a question about comparing FHA and VA. Did that answer your question?
It does. However, the question that I would have on VA, I am currently in this situation with 2 clients right now. The problem that I see with VA is trying to compete in a seller's market with cash buyers out there, when we know that the VA is much more stringent upon the appraisals, things to that nature. Is there anything that you might be able to speak to help us better present a VA offer?
Brian, that is a very fair question. I was just thinking about this with someone the other day. If the vet is limited in terms of their cash and you come in short on an appraisal as a listing agent, I could see where that would be problematic, because if the borrower is borrowing 100% financing, there might just need to be some communication between the agent of, hey, I mean, you're going to run it. I think the biggest issue is probably going in from a listing agent standpoint on concerns about appraisal versus a cash offer. I wonder if it'd be okay. I'm going to do a little bit of research and see what maybe I've got some great VA contacts. Is it Brian Edwards? Is that correct?
Yeah, that's correct. And basically, I think that would be very helpful, as well as if you have any ways of us to be able to make competitive offers as a VA offer in this market.
Yep.
When we're dealing with the other, conventional or cash offers, we're
Perfect.
losing out in several.
Yeah, I want to be able to think about that a little bit, and I'll circle back with you. And then Zareen, if it's okay, maybe you can circle that out with
Yeah,
anyone who's on the class.
absolutely.
Thank you.
I'll do a little bit of digging in and seeing if there's a way to make that go. So are you talking about like cash offers that are over list, or just kind of par purchase offers going up against a VA offer?
It really kind of depends on the buyer, right? I mean, I have one right now that's approved, pre-approved up to 350, and in that price range, I'm up against the gamut with investors and whatever it might be,
Sure.
coming in and just putting a cash offer and beating me out. The other one I was able to finally get under contract. However, we had to go 25,000 over value or over asking price on it in order to get it. And now we're coming up against the possibility of it not appraising.
Appraisal coming in short. Yeah.
Brian, I kind of think when you present it, like obviously cash is king, but if you have a VA buyer, you just have to present it and say, look, this buyer is very well qualified, but they served our country, and the terms of the VA loan are so favorable. Like, just please give them consideration. The
Yep.
lender that we're working with is very skilled in VA loans. I'm happy to have you have a conversation with them so you can understand how experienced that they are, and there really shouldn't be any hiccups with this loan. You just kind of have to sell it.
Quite frankly, that's exactly what I'm doing, Zareen. I've had them write letters basically outlining their history as a veteran, my history as a veteran, my connection with the lender, putting the lender in contact with the seller, and just presenting it in every best way that I possibly can. It's a really tough situation for them right now. So
yeah, it's kind of all you can do.
Yeah. Thank you so much for your help.
Absolutely. I'll circle back with you on that, Brian. Absolutely.
Thank you.
Happy to. And I want to make sure, because I think I've gone over a little bit of time, I'm going to run through this. USDA. So this is a program that you probably don't run into very much unless you're out in more rural areas. USDA is set by the U.S. Department of Agriculture. It allows for borrowers to borrow 100% in rural areas. The tricky thing about the USDA is you have to make sure there's actually a map that goes in, and you have to actually verify if they're available to work in that USDA area. There are some income requirements as well. USDA is a little bit more complicated. So if you're in a competitive purchase scenario in a rural market, let's talk through it, because there are some ways to adjust on that. You don't have to have perfect credit. The benefit to the USDA, again, is doing that 100% financing in a rural area. So I've seen people they've gotten some pretty incredible properties as a result of it, but it does require getting used to that program a little bit. And I'll try to send you guys some additional information as well. Condominiums, you guys are probably, if you haven't run into it, you might start as we continue to sprawl upwards in the DFW area. Condos, something just happened in the last 2 months. I don't know if you guys remember the story of the condo collapse in Florida, which was a devastating situation. Several lives were lost. Fannie and Freddie started looking back at this, and they said, hey, you know what? We feel like this is on us to a degree, or we're going to make sure this doesn't happen under our watch. So now what they put into place, I don't know if you guys are familiar with the idea of a condo questionnaire. If you consider when you're buying, let's compare single family residence versus a condo. When you're buying a single family residence, you're just buying that particular lot. So it's separate. You're underwriting the borrower and you're underwriting the property. But when you look at a condo, you have to consider, hey, I'm buying into a unit. Let's say there's 10 units in this property, in this project. They want to look at the combination of how is this project working as a whole? Is there any litigation going on right now? Are there any big lawsuits? There was I don't know if you guys heard the story, well, you probably absolutely did. The garage in Dallas that fell through with the big, it just collapsed. Well, that was a massive lawsuit, and it kept a lot of sellers from being able to sell because they were in a major lawsuit right there, because you had massive litigation on that property. I can't remember the building. Zareen would probably remember. So anytime you've got litigation, if you have a higher concentration of, it used to be where Fannie and Freddie wouldn't allow you to buy a property that had greater than 50% investor concentration. That's gone away if you were buying as a primary residence, but they still do look at concentration in terms of, does one owner own more than 10% of the units? So if you're on a 10-unit property, does one owner own 2 units? That can be problematic and prevent your property from being considered warrantable. What I started to mention earlier is that they also changed the guidelines now for anything with regards to deferred maintenance. So if the condo has deferred maintenance, and this is what they're going to do, they're getting a little bit intrusive, if you want to call it that. They are now asking for minutes from HOA meetings. They're trying to verify what do the reserves look like? Are there any upcoming assessments? And so you want to, what I would recommend if you're looking at a condo is get a sense from the listing agent. How does this condo look? Do you have any concerns about it being considered warrantable? And the idea of warrantable is basically Fannie and Freddie will lend on it. I don't know where they came up with the term, but a condo is considered warrantable when it passes that condo questionnaire, when they have the appropriate budgets in place, which includes reserves. And then when a borrower is running through the automated underwriting system, depending on how much they put down, you have what's called this is going to get in the weeds a little bit, but you have what's called a full approval or a limited review. So if that limited review comes in, then you have a shorter questionnaire. If you have a full review, then you have a longer questionnaire for the condo association to complete. What it really is just means that the lender's doing more due diligence when the borrower's putting down maybe less money. Condos, you want to make sure that you have a sense of what's going on with deferred maintenance. Are there any issues with some upcoming assessments? And the best way to do that is just get your lender involved early on and then communicate with your client. The best way I've heard of this is saying, hey, like how we're going to do an inspection on your property, the condo questionnaire acts as an inspection on what you're buying into, because you want to make sure that you're buying into an HOA that you're going to be able to sell in 5 to 10 years and not have any issues. So does it make sense on the condo? Any questions on condos? Does anybody run into any issues on those? Okay. We'll circle back with me if I can help with anything on that. Okay, and I think Zorene's going to take this next part on third-party financing. Zorene, I'm sorry if I didn't take too much of your time.
No, that's perfect. You got the goods. We go
Yeah.
over this stuff all the time,
Yeah.
but it's helpful that we can go over it now with you on the phone, because I'm sure there will be questions. Before we get going on this, paperwork side of it, does anyone have any other questions for Jeremy or any general questions?
Quick question for Jeremy, and it'd also be interesting to get your perspective, Zorene. We were working with a potential young couple, first time, and you start talking about, I apologize for my stupid dog. And the problem is young buyers think, you go, okay, do you have a lender? And they go, yes, I've talked to my credit union, blah, blah, blah. And they don't understand how tricky it is right now and how much power is associated with somebody like Jeremy or equivalent in the realtor relationship in the whole deal. And I was just curious, any best practices, and
Can I speak to that, Zorene? I have something to say. Richard, that's a really
how
great
to coach
point.
them, because they're young and they're not necessarily trustworthy, and they look, if you haven't done it before, you just don't understand the dance and the dating game associated with it. So I think
Jeremy,
you get
you
my
go
question.
first.
I'll mute.
Okay, perfect. So Richard, I think it's a very fair question and something that I thought through a lot. Because I work with insurance agents a lot too on our side, I use the same talking script, if you want to call it a script. I'll say, hey, you know what? You don't have to work with Derek, who's my insurance guy. You don't have to work with Derek. However, what I appreciate about Derek is that he is going to explain coverages. In most cases, he can save you money, but at minimum, Derek is okay making sure that you're getting the right coverages and we're getting you into the right insurance. What I like about that is you can parlay that into a relationship with a lender. Hey, client, you don't have to work with Jeremy. In most cases, he's been able to work with our clients and save them money. But what I really appreciate about him is that when we get a pre-approval for him, we can make a strong offer and we know that you are going to be qualified. There won't be issues once we're under contract. My goal is to get you into a property and save you time. If a lender is not known, unfortunately in this market, we've got to do our best case scenario and put our best foot forward. I would highly recommend you work with Jeremy, or at least talk with Jeremy, get an idea of, let's get you pre-approved. And then once you're under contract is really when you want to kind of do the comparison of rates. fees, those types of things. Does that help at all, Richard?
Thank you very much. I thought that was excellent. Appreciate your
Yeah,
time.
I think that that's great. And I think you just have to explain to your buyers, you know, buying a house, it takes a whole team of people, and I'm going to be the quarterback, but we have to have other really good team members, and the lender is going to be one of those people, and the title people are going to be one of those people. So we just need to make sure that we're working with people that communicate really well and that we trust, right? Just explain that it's kind of like a team effort, because they really are your team. You're going to have to be in constant communication with them, and you need them to pick up their phone when you call them.
I think one thing the other thing I was going to say is, Richard, I've heard some concerns about saying, well, I don't want my credit pulled by multiple lenders. Just so you guys know, this is a bit of a nuance. I think it's a misnomer, and it's been some bad information for clients. If people are looking to get qualified, they can have multiple lenders pull their credit. I would say between a 2 to 4 week period. So if someone's starting to look at properties or trying to get qualified, I'd say have them talk to multiple lenders at once. It's not going to affect their scores, because basically the bureaus have said we want clients that have the opportunity to have their scores looked at by multiple lenders. It's just when you start spreading that out over 90 days or having credit looked at by 5 different lenders over a year period, that's when that can it could trigger different scoring models, because it looks like they maybe didn't qualify previously. So I don't think that needs to be a big concern for clients on the credit part.
Excellent answer, Jeremy. Thank you, sir.
Absolutely. Happy to help.
Awesome. All right, guys, we have 11 minutes. We're going to fly through this stuff. So we're looking at the third-party financing addendum. And the first paragraph this is basically the document that you attach if you want to create some type of contingency on your buyer getting financing. So the first paragraph 1 just addresses like which type of loan that the buyer is going to apply for. And typically you just check one box, whether it's conventional or FHA or VA, whatever it is. If you have a buyer that's still on the fence, you could in theory check both, but it's going to make your buyer look like wishy-washy and they're not certain about their financial plan. So I would encourage you to flesh out as much about your buyer's financing as you can in advance. And as you're filling this box out, if it's conventional financing, you're going to check the box next to A, and you're going to say they're getting a first mortgage in the amount that they're financing due in, and then you put in the amount of the years, whether they're going to do a 15-year or 30-year, and then you figure out what's the interest rate. And a lot of times people say, like, what number should I put in there? You can call the lender and ask what number to put in there. You can look up on the internet, like, what's par right now, and just put in there. You just don't want to put anything like crazy in there, right? Your buyer's not held to that they have to get that number. It doesn't have to be the exact number. It's just a guideline of what they're going to be applying for. And then origination charges, those are the points, right, that Jeremy was talking about. And if you have questions, pick up the phone and call the lender and say, what should I put in these blanks, right? Pretty straightforward. Any questions? No. Okay, good. So then paragraph 2, this is where the actual contingency comes in. This is super, super important. And this is a nuance that agents that have been in the business for a long time still don't get. So 2A, there's 2 contingencies. There's a contingency on the buyer getting financing, and there's a contingency on the property getting financing. So A is for a contingency for buyer approval. B is a contingency for property approval. So like Jeremy said, if you went ahead and had your buyer get conditionally approved individually without knowing the house, so that you could check the box that's on page 2. This contract is not subject to buyer obtaining approval, right? You could check that box, and then that's that much stronger of an offer. There's no contingency on the buyer getting financing. We're getting a loan, but the buyer is good to go. So there's no contingency on them. If they are, if you haven't gotten all the way through the pre-approval process, then you do need to check this first box that the contract is subject to the buyer obtaining approval. And then you need to put in a number of days that the lender and the buyer have to figure that out. And generally speaking, I'm going to say you would put 14 to 21 days. Jeremy, maybe some lenders can do it quicker than that, but you need to ask your lender, what's a reasonable date for me to put in there? If you call your lender and the lender's like, I have nothing from the buyer, and they're very slow to respond, you don't want to put 10 days, right? So you need to talk to the lender to figure out what to put in there. So does paragraph 2A make sense, what you need to put there? Questions? Okay, good. So then basically, the date that you put in there, a lot of times agents get confused, because if you put 14 days, then they think they need to have the appraisal done and everything in place by the end of that 14-day period. And that's not true. The only thing that you need to have done in that 14 period is to make sure that the buyer themselves qualify. And that's a date you need to be tracking, right? When you're 3 days away, you need to check check in with your lender and pick up the phone and call Jeremy and say, hey, Jeremy, it's Friday. The buyer's approval contingency is up on Monday. Like, where are we? So that you can extend if you need to, or they can hustle and get it done. Like, that's y'all's job to track that date. Of course, the lender should be doing it too, but you're the quarterback. You're like manhandling the critical dates in the contract. So now paragraph B, there's nothing in this paragraph that you guys necessarily need to be doing, but this is where the property itself has to get approved. And what that means is it has to appraise, it has to qualify for insurance. The lender has to look at the HOA documents, anything that pertains, anything that the lender is going to want to review with respect to the property has to happen here. And this contingency expires 3 days before closing. So if you don't have HOA docs and it's 2 days before closing and you figure something and then you get them and there's something that the lender doesn't like, you've lost your ability to waive because of financing, right? So you just need to make sure that you understand that you have to have your insurance placed, you have to have the appraisal, and all the other contingencies around the property have to be understood and accepted by the lender 3 days before the closing date. So those are two different timelines. You have your buyer timeline, which is what's in the blank, and then you have 3 days before closing for the property itself. Does that make sense? We still will get calls from agents that have been in the business forever that are like, oh, our financing contingency ends tomorrow. And it's not true. That's when the buyer's approval period. So that's a nuance. Good.
Zareen, can I ask a question?
Sure.
So you said for section A, the number of days that you put in that box in the buyer section, that varies. And you ask the lender what.
Yeah. So usually it's going to take, if the buyer hasn't done that yet, I would put at least 10 to 21 days and ask the lender. Jeremy, you can chime in if that's out of line.
Yeah, I think this is the part where if you've got a good relationship with the lender, you want to communicate this. A lot of times, this can be a way where you can make for a stronger offer if you do a shorter time frame, but you also want to make sure you're not putting the lender in a situation where they can't perform. So if Zareen said, hey, we're in a competitive situation, how quickly do you think we get financing contingency? I'd be like, I've already got everything on this client. I mean, we could just put it at 7 days. I think we can get them into underwriting. That might make for a stronger offer. However, if it's a self-employed borrower who she's just sending to me right now, who is talking with multiple lenders and is maybe slow to respond, you might want to extend that out to 21 days because it does protect their earnest money if for whatever reason they were not able to get financing approval. So.
Okay, perfect. And then in paragraph 4, does someone have something to say? In paragraph 4, for an FHA or VA, you got to just put the purchase price because that's what it has to appraise at. Okay. Good. Okay, next slide, please. Okay, so this is the ever popular addendum concerning right to terminate due to lender's appraisal. So you're only going to use this if you're also using the third-party financing addendum. And basically what this document is doing is that paragraph 2B that we just talked about, where appraisal is one of the reasons that the property may not be approved. We are altering that provision right there as it relates to the property appraisal. And so you have 3 different boxes to check here. In the first box, it's a full waiver of the appraisal. So the buyer is saying, I don't care what the property appraises for, if we'll make up the difference, right? So if I'm buying that house for 500 and the property appraises for 400, we're making up the difference. So that's a big promise on the part of the buyer. That's of course the one that the seller wants to see, but the buyer's taking a big risk there in case the appraisal comes back crazy low. But that's still a really strong one that most sellers would want to see. Okay, good. So then the second one is a partial waiver where the buyer is saying, I will waive my right to terminate if the appraisal comes in low, as long as it appraises for at least this much. So the buyer may say, okay, I'm buying this property for 500. The comps aren't really there, but there's probably comps out there for, 475 at least. So as long as it appraises for 475, then I'll buy it, right? And before you fill in a number in that blank, you need to talk to the lender to make sure that the buyer does have the cash to make up the difference, right? Don't just put a number in there because the buyer says, I'm good, I'll cover it. You need to make sure that the lender says, yes, the buyer can do this, right? The buyer has the cash. So don't just fill in a number, have a close line of communication with your lender and check in with them. Does that make sense? people get really, really confused on this. So you're saying we'll waive the right to terminate as long as it appraises for at least this much. So you're putting a little floor on there and protecting your buyer against like a crazy appraisal. So, okay, perfect. So then the last one, this is a totally different situation that's not going to be used as often. This is a situation when the buyer is getting a loan, but they're putting a ton down, right? So, and usually you see if the buyer is buying $1 million property, but they're putting 400 down because they want to stay below jumbo. And the lender only cares about having a certain amount of LTV and making sure they're protected. So maybe the appraisal came back at 800, but the lender wouldn't care because that's their LTV is still satisfied. But the buyer may say, I don't want to buy $1 million property and put 400 down if it's only going to appraise for 800. So the buyer may say, it has to appraise for at least 900. Does that make sense? That's the tricky one. It's basically when when the lender is so well secured in their loan that they're not going to care if it appraises or not, because the buyer's putting so much cash down and your cash buyer wants to protect themselves. Does that make sense? That's the tricky one, but it's important.
Serene, I have
Yes.
a question.
Sure.
So, but when you're dealing with, going up against cash buyers and the seller, or like, let's say in a new construction case, the builder, they've got 4 cash offers. So you almost have to waive this and know to be able to compete with them.
Yeah, I mean, your buyer just has to be comfortable with that. Again, remember, like we manage the process and your buyer manages the decisions. So you just have to explain to them, here's what's happened if we check that first box. You're going up against cash. So checking the first box makes this kind of like a cash offer because there's no appraisal contingency. But you have to understand that if it doesn't appraise, you're bringing up all that makeup cash.
And appraisers, are they using off-market comps or not? They can, right?
They can. I think they need to see a settlement statement, right?
Okay.
They need to actually, you can't just say, I heard this one down the street closed for this much. They need to see it. But everyone, if you can get people to share, you're good.
Okay.
Does that help?
Yep. Thank you.
Okay, cool. All right. Any questions about this one before we move on? It's 10 o'clock. If you guys need to peel off, go for it. I think we have like 2 more paragraphs to go over. So hang in there if you want to. If you need to go, we will see ya. Okay, perfect. So this is one, section 7E and section 7F of the contract talk about lender required repairs. And we're just pointing this one out for a few reasons. One, this is the part, paragraph 7F is the part where it says that you have to use someone licensed to permit to do repairs. So you don't have to write licensed plumber will perform repairs. Like it's in the contract. You don't have to write that. I'd just like to point this out just so that you guys read this paragraph 7E with respect to lender required repairs. If the lender comes back, if it's an FHA and they say you have to fix this, this, and this, the seller doesn't have to agree to pay for those. And then the buyer can terminate, right? If the seller says, no, I'm not doing that, then the buyer can terminate. So the seller doesn't have to do any repairs that they don't want to. The flip side of that is that if the repairs come back and they're worth, the cost of the repairs is worth more than 5% of the sales price, the buyer can be like, no, this house is not in good shape and I don't want to buy it, even if the seller's willing to do it. Does that make sense? Just want to make you guys aware that that's in there. And point out that the contract is clear about how this works. So any questions? It's a little nuanced and you kind of don't really understand it until you get into it one time with a client. So I'm just pointing out that it's here so that it stays in your brain when it comes up. Okay, good. Next slide, please. Okay, and then this one's important. The famous section 12A1B. And basically this is the blank in the contract where it provides that the seller will pay for some of the buyer's closing costs. And a lot of times when you're negotiating repairs, in lieu of having the seller actually perform repairs, the buyer will just ask for an amount of money so that the buyer gets a credit from the seller at closing and the buyer keeps that much in their pocket so that then they could go and do those repairs rather than trusting the seller to do it with their vendors and provide receipts and all of that. They may just say, I want to fix that sink issue and that drywall issue and this electrician thing. And in total, that's $2,500. So instead of asking the seller to do that, I'm just going to ask for a credit for $2,500. And now that we have punch list, you guys can price out exactly what all those repairs would cost, right? Punch list is an awesome, awesome feature that we have. So here's the trick. It's a great, very clean way to do it so that the seller's not making repairs and the buyer can do them on their own with their own vendors. Jeremy referenced this earlier. There's a limit to what you can put in that blank and what the buyer can get back. You can't exceed their actual closing costs. So if you're going to put a number in that blank that's getting large, you need to call the lender and say, what's the maximum that this number could be? Because like Jeremy said, if you put $15,000 and there's only $8,000 of closing costs, that extra $7,000 that you negotiated for, your buyer does not get credit for that. So you need to call the lender and ask what that number should be if you're getting into like a larger number. Jeremy, do you have anything to add?
Yes, and I will, so a lot of the agents that I work with who run into these situations, this is exactly what we'll do, where we'll try to coordinate. Okay, I asked the question, do you want to try to have them bring as little money as cash to close, or do you want to make sure you don't leave any money on the table? Because those two things don't always exactly come out to be the same. But there are creative ways where, let's say you wanted more money than actual closing costs, that can be applied towards discount points to buy the rate down. There's a lot of different ways that you can use those funds. So most important thing on that is just coordinating with a lender to get an idea of what can we get away with, how much can we use for seller concessions. So
okay, perfect. Okay, the next slide, or is that it? Okay, and then the last one, this is the last one, right, Jeremy? I keep saying that, I'm lying. This is the last one. So this is the non-realty items addendum. So a lot of times you have, buyers that are buying some of the furniture and you want to include that. And Jeremy, why don't you explain what lenders like to see here? Because you don't want to say I'm buying $50,000 worth of furniture, because then that, and including that in the purchase price, because then that makes things really confusing on the loan side, because
this is I've
raising
talked
the
to so many underwriters about this, and depending on who you talk to, nobody's really on a clear decision. However, the easiest thing is, generally what I would recommend is just putting $0 if someone's getting a refrigerator or a washer dryer or something like that. Don't start adding it. Now, where it gets tricky is if you're like, man, we want to buy $50,000 in additional, that's where it gets a little bit, you probably just need to talk to a lender and figure out how their underwriter wants that. I've even had underwriters just be like, do that outside.
Yeah, a lot of
we're
times
not supposed to do it outside of closing, but this becomes a very problematic form for most lenders, and because it's a question of what is the value actually on the property.
Yeah, so the key takeaway here is if you have a situation where your buyer is buying a lot of personal property from the seller, talk to your lender and say, how do you want to handle this? And you can just do like a separate deal for the personal property that's not part of the real estate deal. And those are just two separate deals. So talk to your lender is the moral of the story if this number gets big. Otherwise, just put in.
If it's standard items like refrigerator or washer dryer or whatever, I mean,
those are
mostly
okay.
Mostly what we recommend is just $0 in that.
Perfect. Okay, awesome. Okay, so that's all we got. Here's what's coming up next week is pricing a property with Jennifer. It's a really good class, so I encourage you to come. Denisa had a question. Sure. And Denisa, what were you talking about, the appraisal addendum here? She says, if appraisal comes in low, can you still terminate based on paragraph B? And what is the difference between this and the appraisal addendum? Were you talking about in the third party financing? So go back to the third party financing. Sure. Thanks. Okay, so yes. So in paragraph 2B of this, if this is all you have attached to your contract and the appraisal comes back low, the buyer can terminate and get their earnest money back. So that's
the secret on that, though, is you got to make sure, I feel like they added that 3 days in the last couple of years. You've got to make sure that happens 3 days prior to closing. Yes. So you can't have a last minute appraisal show up. Right. Or something like that.
Yeah. So that's the date you need to be tracking. If you're getting into the last week before closing and you don't have the appraisal, closing's next Friday, you need to call Jeremy and say, Jeremy, we have to have that appraisal on Tuesday. Right. And just remind him, right? That's your job.
Can you guys hear me? I just unmuted myself. I figured it's easier to explain because I have run into this situation with a contract I'm working right now, and we don't have an appraisal addendum because, competitive market, whatever. So first appraisal came in so low, and we were trying to fight it. And, the lender told me that my clients are going to lose their
earnest money because we were the paragraph A, we had for the buyer approval, I put 17 days and we're out of that. And he told me there's nothing else we can do except get another appraisal. That's, which we did. And thankfully the second appraisal came up at value. So we're good. But it really confused me because I still thought we were protected based on paragraph
I think he
B.
gave you
Yeah.
bad information.
He gave you bad information.
Yeah.
Okay,
So
good.
next time call
Honestly,
Jeremy.
I was so stressed over this and I felt
Yeah.
like I was the worst agent because I told my clients, so basically you guys are telling me that I was
As long
right.
as it happened prior to 3 days before closing,
Right.
Denise, I think
Yes,
you'd be okay.
it was three weeks before closing.
Yeah.
so-
You
No,
could have,
you'd
in
be
that
fine.
case, you could have terminated or gotten a new appraisal if the underwriter allowed for it.
Okay, thank you.
All
Sorry
right.
that happened to you.
Okay,
That's
No,
stressful.
perfect.
I
All right,
know.
Jeremy, go back to your contact information on the slides. That's all we have unless anyone else has other questions. I hope this was helpful. Thank you, Jeremy, so much for your time.
Absolutely, yes, my pleasure. And you guys reach out. Feel free to email me or that's my personal cell. Text me if I can answer, jump on anything. So happy to do so.
So after this, I'm going to send out an email that has the slides, the recording, and then also a link to the survey that Trek requires that I ask you guys to fill out. And if anyone has any other questions, just let me know. Thanks for coming and hanging in there, guys. Appreciate you.
Thank you.
Bye. Thanks.
Thank you.